So how is it that people can make money when the value of something goes down? I mean, it defies common sense and logic. Yet understanding the concept of shorting and how it works in its simplicity is really essential when it comes to learning about trading opportunities. In fact, making money when prices go downward can sometimes be even easier and quicker than when prices are going up. It seems very weird and very backwards, I know, but stick around. Let's break it down together after this. So hi everyone, Dan here from thejoyfultrader.com, where I encourage you to learn how to take control and manage your own savings and investments through trading. In this channel, we talk about all kinds of things related to the simple fundamentals of trading and investing. And along with that, I also like to include life hacks for simplifying our lives, both literally and mentally. Because I believe that while learning and managing your own investments is great, we all need to nurture a positive and a joyful outlook on life in order to help keep us grounded along the journey. So if you're new here and you want to learn more about the basics of trading your own investments within our positive support group, please consider subscribing to this channel. Hit the like button to help us get the word out. With that said, let's jump into the topic of explaining what shorting is. So if you're brand new to trading or investing and you're just beginning to learn about how this all works, the terminology and what it all really means, then one of the most basic concepts that you may have heard of is called shorting. It has to do with the ability to make money when the price of something goes down instead of up. It seems odd and confusing, especially if this is new to you. But of all the topics that I get asked about from my friends and my coworkers when they want to talk to me about my trading activities, this is the one concept that probably generates the most sideways and confused looks of them all. For example, and this really happens, I've had friends and coworkers who know that I trade my own investments, and they'll come up and they'll ask me how I'm doing trading this week, last week, or whatever, and maybe they saw in the news that, the market was really tanking bad, losing a lot of value on such and such a day. Maybe they saw that Facebook or Amazon or some other stock was getting crushed because of some news, and they ask how it's affecting me. And frequently my response is like, oh yeah, that was one of my better profit days where I met my goals quicker than average. In fact, I'll tell them that I actually like it when the market is going down because I tend to make my money and profits a lot easier than when it goes up. I'll say, you see, I find that prices tend to fall more rapidly than they rise, and I can make money when prices are falling in those situations by shorting. In other words, I actually make money when the market goes down. Now, typically, this is the kind of response that I'll get from nearly everyone when they try to wrap their heads around that concept. I get it. That was me 20 years ago when I thought that the only way a person could make money with investments and trading was to buy low and then sell something for a higher price later on, a week or 2 weeks or a month. I had no idea at the time that when I first got involved, there were all of these other great tactics that I could use to make money other than that. I didn't have a teacher. I didn't have the resources on the internet. Maybe a few books, but I was self-learning and it was slow and I felt alone and I didn't really have a support group. But I remember on days when the market was really going down, I would just sit there and watch and I would think to myself, well, there's another wasted day. I mean, there's nothing happening that I could do anything about. That was because I would buy a stock and wait around for it to go up and then sell it when it did, if it did. But I can't exactly remember when or where I started hearing about shorting as something that someone could do which allowed them to make money when stocks went down. But I do remember that this huge light bulb went off and I felt this excitement about it because maybe now there was a way I could participate in both directions of the market instead of just one. What a concept. I mean, I could potentially have now twice the amount of opportunities to make money. And from my observations, it did seem like when the stock market went down, it went down much easier and faster and farther than it did waiting around for it to go up. Okay, so how does this really work? I love explaining this stuff when my friends ask about it. And so I'm going to assume that you're watching this video because you either don't know anything about this particular topic, or maybe you've heard about it and read a little bit somewhere and you just want to get another perspective. Either way, I applaud you for wanting to learn more. First of all, forget all about stocks and investment terminology and finance and all that stuff. Let's pretend that you have a friend named Bill. And Bill is a close friend of yours, and he has an amazing opportunity to go to Europe or somewhere far away and work for a year. So this is a great deal and one that he doesn't want to miss out on. However, Bill has this car that he can't take with him. So he comes to you, and since you're his trusted friend, he asks, "Hey, can you take care of my car for me while I'm gone? Stick it in your garage, start it up, take it for a drive every now and then, and just kind of keep it in good order until I get back home." "Sure," you say, "I'd be happy to do it." So Bill brings his car over and he puts it in your garage, and off he goes for a year. And to keep the math simple, let's just say that the value of Bill's car right now is $10,000 even. So if Bill sold his car right now, he'd get $10,000. So one day you hear about some information regarding Bill's car that will have a very negative impact on the value of that car. I don't know what the information is, it's not important, but the fact is that there's some new information that gives you a reason to believe that the value of Bill's car is going to go down. It doesn't matter to Bill because he's gone for a year and he's not using the car, but you believe that the value of Bill's car is going to go down at some point in the future. So since Bill is gone and not using the car, you come up with this great idea that you are going to sell Bill's car right now for $10,000. Now, I'm not going to overcomplicate things with titling and insurance and all of that. Just assume that you have the ability to sell Bill's car. So you go ahead and you take Bill's car to the market and you sell it for $10,000. That's the current fair price that the car is selling for. The buyer writes you a check for $10,000 and you cash it and you take it and put it into the bank for safekeeping. You do not spend it. Then at some point in the future, that bad news about Bill's car finally comes out and Bill's car is now only worth $8,000. But here's the thing. He's going to want to come by and pick up his car, and if he doesn't find it in the garage, well, what do you think will happen? You'll have some explaining to do. Before Bill arrives home, you go down to the car market and you find his car, and then you buy it back for the price that it is currently worth, which now is $8,000, not $10,000, because the value had dropped. Remember? You pull out the $10,000 that you received when you first sold the car, and you buy it back for $8,000, drive it home, put it into the garage. And for the sake of simplicity, it's in perfect condition, exactly the way it was when you sold it, not even an extra mile. So how much money do you have now? Well, obviously you have $2,000 left over because you originally sold that car for $10,000 and then you bought it back for $8,000, leaving a $2,000 profit. Guess what? You just shorted Bill's car and you made a profit, $2,000. And because you're such a great person, you're going to split that $2,000 with Bill when he gets back home, to his amazement and delight. Although you don't have to, but you're just that kind of guy. So in other words, shorting is simply the process of making money by borrowing something that you don't own and then selling it at fair market value. Then later, when the price of that item goes down, you buy that item back using the same money that you received when you first sold it. When the transactions are all complete, you have money left over. Congratulations, and that is your profit. It's as simple as that. I mean, technically, you could short any item out there. It doesn't need to be stocks in the market. It could be a car, it could be a house, it could be a horse, or anything you can think of, really. However, just to keep it clear, the item that you sell and buy back should theoretically be in the exact same condition when you buy it back as when you first sold it. After all, it didn't belong to you, and you must return it to the rightful owner in the exact same condition. For example, if you shorted a can of soda and then you bought it back the next day for a cheaper price after it had been opened and consumed, well, the original owner is going to be disappointed to find their soda can empty. You get the idea. But stocks are different. A single share of stock is still a share of stock now and later on. I mean, most people don't actually even put their hands on a physical piece of paper stock, when they engage in the market. It's all just numbers and ledgers, and they're all held by the stockbroker. If you sold someone else's shares of stock and then you bought them back cheaper and you returned it to them, those shares of stock are still essentially in the same condition as they ever were, aside that their fair market value may have changed, but they're still perfectly tradable. No wear and tear, if you know what I mean. Stocks make an ideal item to short because they can be returned at the end of the transaction in the same condition as before. So how does this work then with stocks? How do I actually short stocks when the market is going down? Well, in order to short something, we must first borrow that thing in order to sell it. Remember, shorting requires selling first and then buying it back later at a cheaper price. With stocks, you'll have to borrow the stock, and the way that you do that is with your stockbroker. Now, I don't want to overly complicate this video with all of the nuances about stockbrokers and the requirements to borrow stock for shorting, because the point here is really just explain the concept. But basically, if you open an account at most major stock brokerages like TD Ameritrade or E-Trade or Interactive Brokers, you can apply for what's called a margin account. And this is basically like a credit account where the broker gives you permission to borrow their shares of stock in various companies, and they let you sell them into the open marketplace. So just like Bill's car that needed to be replaced, though, when Bill got home, you'll need to buy that stock back to give it back to your broker at some point in time. So if you do it successfully, you'll make money just like you did in the example about how you shorted Bill's car. And just like in that example where you gave some of that profit back to Bill, because after all, it was his car that you took and sold, most brokerages will charge you some form of small fee based on your profits or another scale, just for the privilege of having them lend you the stocks in the first place. But that's fine, because if you did it all right and you plan your trade well, then you're going to make money. And this is money that you didn't have in the first place to even own the stock. So a plus is a plus. A win is a win. So shorting is basically just the opposite of what most people do with stocks. Normally, people buy stocks, they'll buy low and they'll sell high. With shorting, we sell high and then buy low. So why do we call it shorting to begin with? Well, in the first case of buying stocks and holding it for the price to go up, we would normally call that holding for the long term, or simply put, just being long the stock. And since we're essentially doing the opposite of that, selling high and buying low, we just use the inverse terminology and we call it being short. So you have long and short, therefore shorting. Okay, so if I've been successful in explaining the concept of shorting in the simplest terms, I'll briefly tell you why I was so excited to learn about all of this. To begin with, I could now participate in the market if it was going down, or if I had reason to believe that certain stocks were going to go down. I could then short them and make money, when in the past, if the stock was going down on bad news or something, I wouldn't even consider it for anything. So there was this missed opportunity. From my perspective, not knowing this at the time, I felt restricted to only looking at stocks that were going up or trading in market conditions that were going up. So instead of being limited to only making money one way, I could now double the opportunities of making money by looking at stocks that were both climbing and falling. I had a much larger pool of opportunities to look at. So basically, if the prices of stocks were moving in either direction, up or down, I could potentially make money from those movements. But as the Merovingian said in The Matrix, everything has a cause and effect. Everything has a yin and a yang, and there are negatives and risks to shorting a stock. Of course, it's not without risk, as any investment isn't. So how does risk work with shorting? Well, let's look at Bill's car. You originally sold it for $10,000, but what if some other factor came into play that actually caused that value to go up? Maybe the car became very collectible, and somehow there weren't very many available. Now, let's say that the car's value went up to $12,000. Now remember, Bill is still coming home with the expectation that his car is going to be waiting for him. So what are you going to have to do? Well, you're going to have to take the $10,000 that you first received and then pitch in another $2,000 to make up for the $12,000 required to buy the car back. Unfortunately, you just lost $2,000 to make sure that Bill's car was waiting for him. For example, what if you went long on a stock and you bought it for $10 and it goes up to $20? That's great. You just made $10 a share holding that stock that you bought. Now let's say, what if you bought that stock and it went down? What if it went down to $5? Well, then you just lost $5 a share holding that stock because it went down. What if that stock that you bought went to $0? Well, you just lost $10 a share. In other words, you lost everything that you paid for that stock. But be aware that your losses are only limited to what you paid for that stock. You cannot lose more than that when you are going long on a stock. But how does that work with shorting? Well, as we've learned, you borrow stocks and sell it for $10 a share. Let's try that. So that $10 a share is then put into your account and you hold on to it because, of course, you need to use that to buy the stock back later when it falls. And if it falls to $5 a share, then you sell it for $5 and you make $5. Let's say that you shorted that stock at $10 and the price doesn't go down, it goes up instead. Well, let's say it goes up to $15. Well, now you have to buy it back for $15, but you sold it for $10, which means that you have to cough up another $5 out of your pocket to buy it at $15. Because remember, you need to replace those borrowed shares to your broker who loaned them to you. So in that case, you just lost $5 by having to do that, which is a bummer. But here's the real risk. When you buy a stock and you hold it, hoping for it to go up and make a profit, that stock price could theoretically go up indefinitely. That $10 stock could be worth $1,000 someday or more, and you'd make a killing. It's like buying Apple back in 1981 or something and just hanging on to it. The point is that a stock price can rise and rise and rise. If that stock price went down to $0, the worst case scenario is that you have lost the $10 a share or whatever you paid for it. So in effect, your risk is limited by buying low and selling high, aka being long on the stock. Profits are unlimited while your loss is limited. However, when we go short, it's just the opposite. If we borrow and then sell the stock first for $10 and it goes to $0, well, then we get to keep all of the proceeds of the sale because we don't have to pay anything to buy that stock back because it's worthless. It's $0. But if the stock price goes up and continues to go up and up and up, then that means in order to buy it back and return it to the broker, or what we call covering our short, we have to come up with any and all additional funds above and beyond that in order to get that stock back. So we may have to come up with a lot of extra money, more than we even might have. So with shorting, profits are limited while risk is unlimited. That's pretty scary stuff, and I'll admit it, because it's caused the financial doom of many people back in the day that didn't have money to cover their short. Today, most brokers that allow you to short their stock, though, will have systems in place to prevent that kind of doomsday scenario from happening by making you buy the stock back if the price starts going up really far. However, it's not a safety net, and you could still be on the hook for potentially big losses. So I'm not going to go into detail explaining how all of those systems work in this video and how the brokers calculate that. If you comment below with any questions about this or anything else, I'd be happy to explain it in greater detail in another video. Overall, the equity markets have a long-term track record of growing and moving up. In other words, the buy and hold system of being long has been pretty good at doing well over time. But if you are interested in getting a better return by trading with shorter-term time frames, then considering the ability to short stock is one in which gives you much greater opportunity to profit in the times when the market is not rising but declining. So with that said, there is a stigma with some about the act of short selling. For just one example, some people think that those that short are involved in market manipulation in some way. That is the dishonest control of taking down a stock's share price. And others have said that shorting is a terrible thing because it's basically betting against the growth of a company's stock, hoping that it fails. In doing so, you're encouraging failure of a company rather than encouraging growth and prosperity. But others have accused the act of short selling as being responsible for the entire downturn of a whole market, even recession. But I can tell you that all of that is essentially a myth. And what short selling actually provides is great liquidity to the market and a realistic perspective of companies' potential value. So liquidity is important because it helps to ensure that there are plenty of buyers and sellers available at all times, which helps to keep the price of a stock in realistic check. The biggest factor that drives the price of a stock downward really are people who are holding stocks already long, who decide to unload and sell. Short selling alone is rarely the cause for stock prices to plummet, much less causing an entire economy to spiral down. So just be aware that if you're looking at shorting the market as another tool that you'd like to use in your investment tool belt, then there may be times when others who don't understand it now like you do may criticize you in some way. I've even met people who thought that the entire financial crisis of 2007 was caused by people who shorted the market. And this was solely based on their misunderstanding of the title of the book and the movie The Big Short by Michael Lewis. As a supplement to this video, I highly recommend checking that book out and giving it a great read. I've got a link for it down here below in the comments, along with a couple other books that are related to that. So I hope this video helped you to get a very basic understanding of the concept of shorting and why you should consider it as you dive deeper into learning about managing your own investments. I mean, there are even entire mutual funds out there and other investment clubs that are dedicated to making their returns solely from the practice of shorting, so it's something that is very widely used. All right, here's my questions for the day. First off, what did you learn in this video about shorting that you didn't know before? And what other information would you like to know about shorting? Finally, what was your opinion of shorting before? Was it negative? Was it positive? Did you have one? As a reminder, this channel isn't just about me, it's about you. It's the Joyful Trader community. And so I want to hear your questions and thoughts. I want to connect with everyone down in the comments section below. And I love talking about trading and investment basics. I hope to inspire you to want to learn more. I want to inspire you to take control of your own investments and savings and grow your account to build a secure future. You can do it, starting at any age. You're not too young, you're not too old. So once again, if you're new here, please hit the subscribe button, give us a like, ring the bell to be notified about new videos. And until next time, this is Dan saying, never stop learning stuff. See ya.